We're still talking Horizon Markets. My guest from our Cape Town Bureau, Kamal Ahmed, PM at Investec Asset Management, and of course guest host Kobie Legrand and Roland Rousseau. Kamal, let's throw back to you and talk about concentration risk because we've got that graph. We just want to reiterate, the issue right now when we're talking about emerging markets and the fact that Horizon Markets are such a small part of this universe right now.
Well, there's a graph here that shows you what a sample of two smaller emerging markets, substantive markets in their own right, Indonesia and Chile, are relative to the emerging markets or the BRICS with regard to correlation. So if you look at country correlations to the MSCI Emerging Markets Index or the BRICS, you will see that markets like, for example, Indonesia and Chile, smaller emerging markets that form part of my Horizon Markets universe, these markets still have lower correlation, and yet they have not given up the potential for return. Indeed, we show you through our research that in general, smaller emerging markets, and one really could have taken any one of several samplings. We chose to use Indonesia and Chile for this setting. You will see that Indonesia and Chile over the last decade have returned substantial, convincing capital market gains relative to BRICS and the Emerging Markets Index, while at the same time diversifying volatility. That's a key part of our thesis.
Kamal, is the reason for that these countries are, if I can use the term, inwardly focused in the sense that they depend or are exposed much more to domestic GDP growth and economics, whereas the large emerging markets are driven much more by what happens in China and sort of global effects and are far less domestically driven, and that sort of creates the opportunity in these smaller markets to pick up uncorrelated returns in terms of earnings and dividends and those kind of things.
Roland, I think you raise a critical point. I don't think there's any doubting that the large emerging markets are much more geared in terms of international trade, in terms of volatility from international markets and their interlinkage with markets in general. However, we also believe and argue in one of the white papers that we've written on this thesis. In fact, as you may know, we've published 3 white papers on the Horizon Markets. We argue that perhaps one of the least understood macro catalysts over the last decade is the World Trade Organization, the WTO. And let me just take a quick moment and explain what I mean by that. As countries accede to WTO membership, they are bound by accession treaty to systematically liberalize their economic sectors. They may have grace periods for certain homegrown industries, but at the end of the day, these sectors and industries must open themselves up to competition. So consequently, over the last decade, what you've witnessed across emerging markets in general, including the large markets, is a significant transformation structurally of their economies. And as this has unfolded, you have seen the rise of domestic demand. So there's absolutely no doubting the fact that the rise of domestic demand, the rise of the middle class, the increase in middle class incomes, consumption, propensity to consume, etc., has resulted in an opportunity set that is largely domestic focused.
When you talk about correlations, just also important to point out, the correlations between the various emerging markets.
Yeah, I mean, look, again, just for the viewer's sake, what is a correlation? A correlation is for every 1% one market moves, what happens to another market, or a stock for another asset class, or a stock for a stock. And often what happens is you look at those over rolling 5-year periods. Now, Kamal's been talking about the correlations between these markets. Let's just show you quickly what that graph looks like. And what you're seeing over there is you're seeing rolling 5-year correlations for small emerging markets. And if you look at the MSCI Emerging Markets, which is the whole index, well, quite frankly, it's perfectly correlated with itself because there's no variance between those. But how about BRICS? And you can see there's a big correlation, 90% correlation between that and emerging markets. But once you start looking at Indonesia and Chile, which are the 2 examples that are kind of being utilized here, look at the correlations, how different they are. Certainly the period 2005 to 2007, you certainly picked up a correlation benefit for being in those 2 countries. And then more, and as important, is the correlations amongst the top 25 stocks. And here you're looking at top 25 stocks in large emerging markets, the small emerging markets below it, horizon markets, and then frontier markets. And you can see the correlation amongst those are obviously far less. That means the fundamentals in one doesn't necessarily drive price performance in the other one.
Yeah.
There are different things driving
And
them.
then, of course, where stock picking would come in and understanding each individual company and what drives it and how well it's managed, corporate governance, all these kind of issues are important to look at. Kamal, talk to us about stock picking in horizon markets and how you approach it from that angle when we're talking about the fact that there are, the correlation between stocks in horizon markets is a lot less.
Well, I mean, certainly the whole proposition behind an actively managed bottom-up stock portfolio takes very much into account correlations across markets, across sectors, across investment opportunities. So our view is that an initial universe of 40 markets, and incidentally, we've identified 99 countries that we think are potential horizon markets, but currently our investability screens lead us to 40. We think that across 40 markets, we can build a portfolio of stocks that have, on balance, lower correlation. This isn't necessarily a low volatility product. I wouldn't make that argument, but it's certainly less volatile than what we've seen come out of the emerging markets index or indeed the BRICS as a grouping. So bottom-up fundamental valuation very much comes into play as we're looking at either defensive, cyclical names, particularly well positioned at certain points along the economic cycle to benefit from increased domestic demand, and indeed some of these countries' growing linkages with international markets, not just domestic stories.
Yeah, we can, Camille, maybe we can look at the amount of capital that we should be allocating to horizon markets. And we've got a slide that looks at, again, the risk-return trade-off we saw earlier on, but we're trying to now look at the blend of the different opportunities. What we have is we could put 100% in emerging markets. We could put 100% in the BRIC countries. So we could have the green dot there is 100% in MSCI emerging markets, and 100% in BRIC would be the pink dot on the right there. And you can see all the way on the left there in the top left-hand corner are the horizon markets. Now, that nobody's going to put 100% in these kind of markets. So if we put 75% in emerging markets and 25% in BRIC, we will be at that blue square there. And that's sort of, and I'm asking you this, Kamal, a bit of double counting there because BRICS are part of the EM universe. So my suggestion is, what if one puts 50% in horizon markets and 50% in BRIC? Is that sort of a kind of non-overlap, but also trying to benefit from the risk-return trade-offs?
I think that's a great question to ask because candidly, that's probably the best asset allocation choice you could come up with for a portfolio's emerging markets allocation. However, in my experience, it's highly unlikely that investment committees or trustees, simply because there is a certain accepted market wisdom, whether right or wrong, about how allocation should take place, whereby much of the money into the large emerging markets is in the form of global emerging market strategies. So ironically, a combination solely of BRIC and horizon is probably the best outcome.
But of course, as you say, many people not willing to take that risk right now. Is that what you're saying, Kamal?
Yes, I mean, I think it would be a tall order to go to a plan and its committee and argue that half your money should be in the BRICS and half your money should be in the horizon markets, even though it presents as the best potential option, and even though we would argue that might have a great deal of merit in portfolio construction. So instead, what we show is that a combination of emerging markets plus a dedicated allocation to horizon markets not only improves your efficient frontier, but is a wiser asset allocation choice.
Kamal, I mean, we've talked about this universe where we've got around 40 horizon markets that are investable right now, but you say you've identified 99 potential horizon markets. Just delve into one or two for us. Just give us an idea, paint a picture of some of them that are really most exciting right now. You're spending a lot of time looking into stocks there and the opportunities for growth when it comes to those company earnings.
Look, I mean, you know, we like some of these markets equally, which makes it quite challenging from a bottom-up valuation perspective as opportunities present themselves. So a country such as Turkey, might have opportunities as compelling as a country such as Nigeria or Chile or Thailand. So the goal we have as an investment house is across globally constituted sector teams, using peer group analysis as well as country and regional expertise, crafting a portfolio that from a bottom-up point of view, together with macroeconomic analysis imposed on our bottom-up stock selections, presents a portfolio that makes sense from a risk-return perspective. Earnings might be coming in very strongly in one market, might be coming in less strongly in another market, but the valuations of that market might present very interesting value opportunities.
Mm-hmm. I mean, Kamal, just a question maybe from my side. It's tough enough to go and kick the tires of some businesses in G7, but what about these markets?
Yes.
I mean, would you guys literally go and visit some of these corporates, or are we talking about a quantitative valuation-driven model? Do you guys literally go and look at this? And I mean, Africa, I suppose you're in South Africa now, so it's much easier to kind of get into Africa to do that.
That's an excellent question. We don't have a certain hubris about our ability or our knowledge of these markets in the least. And so the strategy that Investec has crafted is a combination of direct stock picks plus allocations to a select group of local asset managers that we call partner managers with whom we have partnered for this strategy. It would be very difficult for us to argue that we know the idiosyncrasies of a Chile as well as we do a Vietnam, or a Turkey as well as we do a Kenya. The idea is to have the team here in Cape Town do bottom-up analysis on our universe of 994 stocks, identify over time 30 to 40 very compelling investment opportunities, and invest in those directly. In addition to that, we would have allocations of capital to a handful of regional funds and single country funds that have been identified after an enormous amount of due diligence, really stretching over a matter of years, to select managers in regions and countries where we can build on their on-the-ground expertise to improve our knowledge base.